Imagine losing $50,000 of your hard-earned money to fees that you didn't even know about. This might be you, and in this video I want to cover this. And you might think, Adam, I'm not paying all these fees, I do it myself. Oh, there could be hidden fees that you don't even know about, and I want to make sure you do going forward so that you can avoid them and save yourself a lot of money. And the reason I'm doing this video is because I've come across this situation 3 times in the last week and probably 50 times in the last year. So it's very common and it's happening to a lot of you watching this video. Before I jump into it, if you're not already subscribed to the channel, make sure to hit the subscribe button and the notification bell. We release 2 brand new videos every single week, so join our channel. The fees I'm talking about here come in threefold. First off, DSC, Deferred Sales Charge. The second one is LL or low load. The third one is transfer fees. And let me break each one down individually so that you can determine, have you created an issue for yourself that you don't even know about? Now, one thing to keep in mind with deferred sales charge is they were outlawed here in Canada back in 2022. So you haven't been able to sell them since 2022. You won't have any DSC funds from the last couple of years, but maybe your advisor sold them in 2021, late 2021, right before they went out of service. And you've only been in that fund for 3 years. And this is what I had a client yesterday, and this is what triggered this video. Let me quickly explain what a DSC fee, a deferred sales charge. Now this is a fee charged to the investor, you, if you sell or transfer out your investment before a specific time frame. This fee is often used by investment companies to discourage you, the investor, from pulling out your money early. Now there's a few things behind this that I think I also need to explain, in that when you buy a deferred sales charge, or when you bought one originally when they were still allowed to sell them, your advisor was paid around 5% commission. Now, I just came across an account last week that was over $1 million that was all deferred sales charge funds, meaning that this person's advisor made over $50,000 upfront plus an ongoing trailer fee to manage the money. They may not receive every penny of that where they work, and there might be a bit of a split there, but at the end of the day, there's $50,000 of commissions being split out there. Now, a DSC fund will typically decrease over time, and I'll show you that here in a second, but typically you have to hold this investment for up to 6 or 7 years to not incur any fees to either transfer it out or to redeem it, period. Now, if you do hold a DSC fund, a deferred sales charge fund, there is a 10% allotment every year that you can take out free of charge. So if you have that $1 million in there, you can transfer out or redeem, if you're in retirement stage, up to $100,000 every single year. So there is a bit of a leeway there, but again, you're only allowed 10%. You're capped. So let's use an example. Let's say you invested that same $1 million, for simple math, into a mutual fund, and your advisor put you into a DSC fund. You were in it for 4 years and things just weren't going well. It wasn't going well with the advisor. They weren't giving you what they had promised. The investments haven't done well, and you just want to part ways and move to another firm. Find a different investment option. Find a better planner. Well, 4 years into your investment, there's still a 4% DSC fee attached to your account. Meaning that even if you wanted to move, the fee to move out and away from the advisor that's not doing their job properly, the investments that haven't performed well, is going to be about 4% or $40,000. So very punitive. So this is why it's really, really important to understand, do you hold a DSC fund in your account? Now, you may hold something called a low load fund, and it'll have an LL beside or behind the name of the fund on your statement. And a low load fund is very similar to a deferred sales charge. It came out a little later in the early 2000s, in that a low load fund basically is the exact same thing, except it's trimmed down a little bit, meaning that you don't have to hold the investment for 6 or 7 years. It's typically 2 to 4 years. The fee after 4 years would be 0%. The fee after 2 years might be 2 or 3%. And your advisor doesn't make 5% up front. They typically make 2 to 3% as well. So everything's kind of cut in half, but same idea. If you hold a low fund and you haven't held it long enough, you will pay a fee to get your money out. So let's assume that you look at your statement and you see the word DSC behind, in front of a fund that you own. So how do you figure out, is it actually a DSC fund? Am I going to incur fees? What's this all about? What is the fee I'm paying? So for any mutual fund or investment that you own, you can just go to good old Google and type it in. So on my statement, if I saw the fund ATL 1162, I could type that in there. Or again, I could do the name of the fund, ATL Global Healthcare Fund. Again, it's going to bring you to the same links on either side. So if we click on here, the Renaissance Global Healthcare Fund, typically I like to go to the investment company website. You're going to get the best data from there. You're also going to be able to download and view what's called the fund facts, which I'll go over here in a second. But you can see here, if I scroll down, typically this is near the top of the page, the front end load option, meaning that this is the investment fund where if you had invested, you can pull out free of charge. This is the one you should have been in, but you were invested in 1162, which you can see here is, sure enough, the back end load option. Now there's also the 2162, which would have been the low load option. Now again, these are close to purchases. Like I talked about before, those are no longer being sold, but the ATL 1161 is. So going forward, if you were to invest in this fund, you would be put in the 1161. But for those of you that were invested a few years back, you may be owning 1162, and we just came across that with a client. So what you want to do here is figure out, like, what am I paying and what is the timeline on selling my DSC fund. So you want to look for something called the fund facts. So if I click on the fund facts, it'll open it up here. Now the fund facts is typically a 3 to 4 page document. These came out about 10 years ago, maybe just under, but it's going to break down the key components of the fund. So you can see here, this is 1161. Again, I can't pull it up for 1162. It's a discontinued fund. So I'd have to talk to my advisor to figure out, am I still paying 2.51 or am I actually paying a little bit higher? Now, as you can see, 2.51 is a fairly high fee already. So this is a CIBC fund internally in there. And that's why you got to be careful what funds you're getting into, because these fees can be astronomically high. Again, it'll show the top 10 investments, blah, 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 medium risk, all that. Investments, high and low, long term. Now, what I want to get to, though, is this deferred sales charge. So you can see back end load option. If you sell during the first year, 5.5%. Now it goes all the way down, like I said, during the 4th year, it's still 4%. So after the 6th year, meaning you're in your 7th year of investment, finally there's no fees. Low load, same thing. First year, 3%, 2, 1, 0 after the 3rd year, meaning once you're in your 4th year. The other thing that you can look at on these, and this is, another fee that you're paying that a lot of you aren't aware of, is your advisor will say, no, your MER, your mutual fund fee is 2.51, and they'll show you that top number that I showed you earlier. But the reality is there's also what's called a TER, a trading expense ratio, and you can see that it's 0.13% here, meaning that your total cost to own this fund is 2.64. Now, I don't know about you, but if I was paying 2.64% for a fund and I couldn't sell it for 7 years, I'd be pretty pissed off. But that's just me. But I think a lot of you are much the same. So this is why I get very frustrated seeing these client statements come in. They want better planning, better investments. They need a change. They've had terrible service for many, many years, and their hands are tied to the point where, again, this client that we were looking to transfer over, get them into a better investment solution, do some planning with them, they can't do anything. Their fees were around $50,000 to transfer. There's no way that makes sense. So what I want you to do right now is actually take action on this. Pull up your investment statement, and if you have any mutual funds or segregated funds, and again, you could have a portfolio with one of the big banks, and you might own a bunch of individual stocks, but you might also own some ETFs and some mutual funds. If you own any mutual funds or segregated funds, jump into your account, into your statement right now, and take a look. If you see LL or DSC beside any of those funds, it's a bit of a red flag. You want to have that conversation with your advisor. Now they might say, oh yeah, but Sally, don't worry, you have a DSC fund, but we can always move you internally from this fund to that fund. Okay, that's fine, but I'm stuck with you. What happens if you're not giving me proper planning? What about if you're charging me too high? What about this, that, or the other thing? Am I stuck with you, the advisor? Because as a client, it's your money. You should be able to do what you want with it. And if your advisor's not providing the value for their fee, you should be able to move without any cost. And for a lot of you, that's not the case. The last fee I want to cover that many of you are going to pay that you haven't thought about is, I would say, primarily around DIY investing, which I know are a lot of you watching this video. You might say, okay, Adam, I don't have DSC low load, I manage my own money, I own individual stocks, ETFs, or whatever it is. Be aware of what custodian, like where you hold your money. Because some of these investment brokerage firms that you're paying $10 a trade, maybe they're free. If you ever need to transfer out your money, they might be dinging you up to $250 per account. And if you're married and you have 6 or 8 accounts there, it's a very expensive fee. So don't get caught by the 0 transaction fees up front, because there could be a large transfer out fee on the other side. Now, fortunately, if you have enough money, transfer fees can be covered. So if you move from one fund or one investment firm to another to do DIY investing, they may cover that $250, the $150, $75 fee, but they may not. So be aware as you kind of move, if you're someone looking to move DIY, make sure you don't just look at what are the fees while I'm there. Look at the fees of what happens if I don't have activity in my account. Sometimes there's a quarterly fee. I know I used to be with Q-Trade years ago, and every quarter I didn't make any transaction, they charged me $25. And then when I transfer my account, they charged me another $200, I think it was, $150 or $200. Like, there's huge fees there. I didn't even know about it at that time. And that's why I'm warning you, all of you. Be aware of what the fees are. Ask your advisor if you're working with an advisor. I get asked every day, Adam, what are your fees? What do you guys charge? We're very transparent with it. In fact, most of our fees are right on our website. And people love that. They know exactly what they're going to pay. That's the way it should be. Our industry has done a very poor job at communicating fees. Even when we had what we call CRM2 come out many years ago now, 5-10 years ago, around fees. The whole idea was, let's have better disclosure around fees. But what happened is only about half the fees were actually being disclosed. So the client thought, oh, here are my fees. But it was only about half of them. So again, like, there's been bad transparency. And I think the best way for you, the client, to go about this going forward is to have open and honest discussions with your advisor. Make sure you understand fully what you are paying, how they're getting compensated, and then you can determine, am I getting value for what I'm paying them, or is there a better option elsewhere? I think that's really important and could save you, like some of our clients, tens to hundreds of thousands of dollars.